Hi guys, and this is a video where I'll be explaining on an approach or how to look the market in case if for the option traders. And from my observations, I have connected the dots and I have come up to give it a better understanding to keep up the success rate of a trade to be much better. Um, this is not an like 100% success rate concept, or there is not the thumb rule to give the better success rates to be keep it better rather than losing more trades and so on. So this video does not cover an explanation or any understanding of the option geeks or the best strategy for options or time decays or anything in-depth understanding of an option. It will be a basic understanding of options and combining the technical analysis with the options, to see what best could be to do could be possible. So let's start with that. And an option trading is volatile trading actually. So an option trading, uh, as it is volatile trading, so when there is an volatile in the market, the premium of the option which you have, right, which you have, the premium will start spiking and the premium will start jumping very high. As the high the volatile, the premium jump will be higher. So then that is how we make money. So if there is no volatile in the market over a period of time, then what happens is the premium which you have bought starts like getting like starts crunching because of the time decay, and by the expiry the premium will get to zero. And so that is what happens. So let's understand the volatile. The when the Nifty index, the Nifty 50 index could be volatile is when there is a news for the sectors, or if any companies announce a huge fund for what do you call R&D, or if there is any acquisition of a company's RBI news, or if there is any government is giving and news and so on. This could be this could give a volatile in the index, but the direction of the volatile is unknown. So if the news is good, there will be positive volatility. That means the market can jump up, or if the news is bad, the market can jump downwards. So again, unless the news is announced, so we will never know in which direction the market will be volatile. Sometimes there won't be any volatile as well. So that is also possible. But the other way is if you understand your technical analysis, that understanding a trend that would be give a decent volatile, so that is sufficient for the premium to jump, and then you can make a pretty decent money in that. So let's understand the trends in. So one is a bull trend, the other is a bear trend. Range bound market I haven't covered here. The reason is because the option over a period of time, if it doesn't trend and if it is in the same range bound, as I said, the premium starts crunching, and over a period of time, because of time decay, you will end up uh, losing the money by the time of expiry. So but again, there are some strategies we can add together even to make money at the range bound, but I'm not covering that one right here. So understanding the bull and bear trend. So bull trend or bear trend, there are impulse and corrective wave. If the market movement is in the direction of the trend, then that's an impulse wave. So here, this is a direction of a trend, and this is impulse. And for, the market is moving in the opposite direction, and that's a corrective wave. Similarly, there is a direction of the market in bear, and this is impulse. This is against the market direction, and that's corrective wave. So impulse wave is more or like the course of a river, where the impulse wave is much faster in travel as it's along with the trend. Corrective wave is, since it's opposite direction of the trend, there will be slowdown, or there could be some sideways or choppy side happening of the market can also happen there. So in the impulse, if you will have some decent volatile. So if you are good in understanding your technical analysis in the sense it's not with the indicators, you draw swing trades or and support resistance with some pattern understandings, or fib retracements and trend reversal patterns and so on. So understanding that will help you to understand which trend you are in, bull or bear, and whether are you in impulse or corrective wave. If a corrective wave, just wait for the market to start its impulse wave. Once impulse wave starts, that is where you catch the volatile, and that is where we have to enter the option markets. So understand the trend, understand the impulse wave. So this will give you a decent volatile, as we expect for the premiums to um, jump or improve over the time. That is one point. The biggest problem with the option trading is, option trading has an expiry. So in Nifty 50 has expiry on every Thursday, weekly Thursdays expiry. So after these technical analysis, I have figured out like what is my target and so on. So how do I decide which expiry will be in the right expiry for me to wait, so that uh, I can hit my target, so that the market doesn't slow down with some decent volatile, and then I can make some money out of it. So I have added few variables in them to understand which expiry would be right expiry. So the first one would be, let's understand how many points Nifty moves in a day. The second is the multi-time frame analysis, uh, meaning that which time frame would be best suitable for option trading, and the target in that time frame as well. And the last one is at which day we get an opportunity to enter this impulse trend. So putting these three variables together, I have given some approximations, but this is again not a thumb rule or a route map. You have to decide the exact. If you put all this together, you get an exact output. It's not a formula. So let's understand with what is the total number of points it moves in a daily Nifty 50. From NSE website, I have pulled the 13 years of data from 2000. Give me a second, from 2010, yeah, from 2010 Jan 4 to 2023 Jan 31. So this 13 years of data of Nifty every daily is data. So just have open, close, high and lows. I have did an absolute value of high and low and absolute value of open and close. In simple, um, yeah, this one. This high and low is the maximum stretch in a day where the bulls and bears had pushed the price of a Nifty 50, and close and open. This is the body of the candle in which the market has closed on that day, in which the market has opened and the market has closed. So that price I have added here, and absolute value is to remove the negative values actually. So then I have calculated the average of the column F and column G here. I have did a median, not mean, because there is wide range of data here. So median would be the right metric to get an average of, if the data is having a very wide range of data. Then so here it says this is open and close, where the body of the candle, this is from wick to wick, high and lows. On an average daily from the last 13 years of data, I have come to a conclusive that the body of the candle would be, on an average it is 42, what do we call, 42 points, and this is like 89 90 points on an average on a daily basis. Why this understanding is much important is, if I understand on a daily how much points it moves, from my technical analysis on the charts, like 4 hour time frame, as I said, if my target is like 400 points, and again I can come to an approximation that these 400 points, on how many trading sessions I can expect that the target might hit with this one. So it's like 400. It is my, sorry, if it is my 400 points, if it is 400 by, like if I consider 42, then it's 9 to 10 trading sessions. Then again, if it's 400 by 89, then it's 4 to 5 trading sessions. Again, this is an approximation. This is in consideration that where, say assuming I am in a bull trend and I have 400 points to catch, then this 42 points, it happens every day, one above the other, then I can say that this formula would work. But will that is the is that the real scenario? No. The reason is, the market can go up 40 to 42 like this, then again there could be small correction of some points, then again it can go up. Because of these negations in the market, I said this will never work. So that is the reason, since these data have pulled on a daily basis, that is the reason the technical analysis on the chart which I have proposed is not to be on daily. We can go one time frame down, that's 4 hour time frame, or even 1 hour time frame will also be a good chance. So that is one. So understanding on a daily move of Nifty 50 is one keynote. The next thing is, as I said, time frame. As I said, this neck to neck, this points will never always keep pushing up. There will be small corrections and in the market as well. So that is the reason. Since these points I have pulled out on a daily basis, the analysis on daily basis won't be a right choice. So we can go for a 4 hour choice because of this. This structure could happen in the market as well. Next is on the day of entry. Say every Thursday is expiry, so I have say fourth as expiry. So now I have opportunity to enter the market with this impulse. I'm trying to catch up. I've got that opportunity on Wednesday. So say I have some 250 points to catch. So these 250 points I won't be able to reach out in Thursday. So what I do is I choose an expiry on 18th. Again, I'll have to look for if there is any trading holidays on this Monday, Tuesday, Wednesday, or this Friday in between these two. And if there is any trading sessions or holiday, then again I won't be able to catch that up. So then again I have to look whether the points I'm expecting, the target which I'm expecting, and the volatile, can that be covered up in the remaining trading sessions or not. If no, then I have to switch to another expiry and wait. So don't go out of the expiry, like the expiry don't go very too far. That's not ideal scenario to look for, or one or two expiries, that would be a more ideal scenario. Again, considering the trading holidays and your targets in which you wanted to do. So this is deciding an expiry and deciding in which wave you have to travel to get a decent volatile where you can make a your premium will start jumping, rather than slowing down or started crunching down. Let's see the upon chart now. So in case if you are in a bull run and you have got an option, the impulse wave, then you have to buy a call options. Then if it is a bear run and you are on impulse wave, then you will be buying a put options. So these are the strike price here, and these are the premiums of the strikes for the bulls and puts. Then here the shaded area, this is in the money, and the white areas are out of the money. The meeting point is at the money. Right now, 18,100 for the 4th May expiry is the at the money. Okay. So now say for example, I have an entry right now and my target is 250, where I have trying to catch like 150 points. Then which strike price is an ideal to choose is at the money will be an ideal. And as you go deeper the out of the money, the premiums are very low and it goes very low actually. So when there is a volatile, the premiums at the money strike will spike very higher actually. As you go deeper, the jump in the premium will be very low. Say here, the jump in the premium at 18,150 compared to jump in the premium at 18,550. Here it will be very higher and here it will be very lower actually. So don't go very deep out of the money. Instead, either be at the money or one or two strike prices out of the money, so that the premium jumps will be a pretty decent one. And don't do anything in the money options because the premiums will be very higher actually. If you see here, the premium 76, as you go deeper in the money, the premiums are very high. So that is not where we are looking for. At the money or one or two strike price into the out of the money is then ideal strike price to choose with. Again, you can add the lot size as per your risk and your capital in your account. um, and you can enter that one. You can enter the option one. So this is basic understanding on options. So let me see the chart now. Let me show something in the charts. This is Nifty. Okay. So let's see what's happening in weekly. The weekly is this high is broke and now it's higher high, higher low, and then again this higher is broken, higher high. Now the weekly trend is bull, but the market has reached its previous low. Right now it's in a double bottom, and if the neckline breaks and the market can expect high, it can go up actually. So right now the market is in bull, weekly trend it is in bull, but it's in double bottom and then market is moving up. So this is the scenario. Did it I have synced them in the 4 hour time frame. As I said, the 4 hour would be an best choice to trade with. So this is a 4 hour time frame. I have synced these zones actually. Now let me push this big. So if you see here, this the crosshairs has been synced with both the charts. If you see my crosshair, this is weekly. So higher high, then this is a higher low. Then there is a trend reversal here, and then the market has moved up. So this is how the weekly trend in daily looks like. Sorry, 4 hour it looks like. So in simple, I'll show here what happens. So let me show two trends here. So as I mentioned here, this is higher high and this is a higher low, and here I have to look for a trend reversal where the market is about to jump. I mean, it goes to new higher high. This is my impulse I'm supposed to catch here. And again, if it is a lower low and then lower high, if there is a trend reversal here and then I'm expecting market to go further down to form a lower low, and this is my impulse, I will be catching up here. So let me show one bull trend and one bear trend in the Nifty right now. So this is higher high and this is higher low in 4 hour. So this is the area. So let me mark that. Now let me see if there is a trend reversal here and how far the market can jump. So 30 minutes. See, this is the higher high and this is the higher low. This low is a corrective wave. Since this is the along with the trend, you can see there is a jump in the market, higher high and a higher low, then like this. Then again, this is against the trend of the market. The market is falling down, lower low, then lower high, then again lower low. If you see, this is the range bound here. So this is a range bound here. The market was in a tight range, and then there is a breakout here. This is in a range bound, and there's this big green candle has a larger body over here. This is a solid breakout here, and then the market has went up for the bull. Now after this breakout, assuming we are entering the market right from here, okay, so you can place your targets based on your fib or based on the support resistance of the daily or weekly time frame. Till that range you can consider. For now, I have considered my fib target as where is it? Where is it? Where is it? So this is my first target and this is my second target. So let's see what is the first and second target. Uh, uh, the number of points to reach there and how long it has taken to reach as well there. Okay. So now here, this is broke here. Right from there, let's start calculating this from here. Since this is the first target to reach this, this is one, and the second target would be this candle. This is my second target. Okay. So if you see, let me zoom this. Okay. So the first target here it is 226 points here. So again here, if you see the top here, this is the 4 hour top. You can see in 30 minutes I have drawn this. So this is a 4 hour top, so this is a 4 hour support. So if I consider that, okay, till max I can reach for 4 hour support, because there I can expect some big volatile, then there may be a slowdown. It's like a speed breaker in the highways. There could be a slowdown, because if you see here, there is again drop, then again there's a market, there is a big wick here, green, and then the market has spiked up. So you can expect a slowdown here. So if your understanding is, I can expect from one range to another range, that is like one support. From here there is a support, and this is another support. Within this range bound, if I can enter the option and then make me profit and come out, that is also fine. Or if you have other ways of setting your target like fib, or if there is another method, that is also fine. But please do add your support and resistance of your like higher time frame, like daily or weekly, because the pressure of weekly or daily would be higher than 4 hour. So that there will be a slowdown in the market. If there is a slowdown, there won't be volatile. Then in the over a period of time, your premium will start crunching down. To understand that, please do draw your support and resistance of your analysis time frame like 4 hour, and then higher time frame like weekly or daily as well, to understand how far the market can stretch, or there could be a decent volatile. Fine. Right now, assuming this is my 4 hour support here, um, and again, as I said, the first target I'm mentioning it here as to be 226 points. If you see how many bars we have 35 bars. 35 bars of 30 minutes. Okay, so let me simplify, like 35 bars of 30 minutes. So it's like 60 minutes is 1 hour. So 30 minutes is like zero point 0.5 hours. Zero point 0.5 hours is like 17.5. And then in India, the trading sessions is 6.5 hours. So I'm dividing it by 6.5. So that gives 2.6 trading sessions. Roughly, let's assume it's a three trading sessions. So in the three trading sessions, I am able to catch these 226 points in one go, and then I'm these three trading sessions. Fine. Why did I come up with 6.5 is, let me show here. Yeah. So this is India Nifty trades in NSE for 6.5 hours from 9 to 3:30 p.m. If we calculate 9 to 3:30, it's 6.5 hours. Then the remaining Nifty is traded in SGX in Singapore. That is 16 hours count, where after 3:30 the market still continues. I think from 4 o'clock the second session starts, and it extends to till 5:30 p.m. And then again the Nifty in Singapore starts from 6:30 a.m. The portion in which the Nifty is being traded, the time in which like from 4 to 11:30, and then from morning 6:30 to 9:15, it is been adjusted from 9 to 9:15 and the pre-market. And that is the reason you could see a lot of gap ups and gaps down in Indian market as well. So in case if you have difficulty in understanding the trend because of the gap ups and gap down and then the candle formations, please refer your SGX Nifty, and that will have a clear structures to understand the trends as well. Okay, fine. I'll show that one in the last part, in case if there is a confusion in the trends as well. So since I said in India we have 6.5 hours as trading sessions, that is the reason I have divided by 6.5 to show the number of trading sessions it took to reach these 226 points. Now let us understand in which day we will be entering this market. Let me zoom in much more. So this is the breakout, and this is where I'll be taking my position. So breakout has completed at 9:45 a.m. on 22nd November. You could see the date there in the black. 22nd November 9:45. There is a complete. So let's go to November. November 22, right? Yeah, 22. November 22, 9:45 a.m. Fine. Then, so November 22, 9:45 a.m. If I say buy there, since it's a bull trend, I've got an impulse wave, so I'll be buying my call premiums. So that is 22. Okay, and the expiry is on Thursday. So my target is 226 points. The first target, as I said, will I be able to catch the 226 points in reference with this data? This is again approximation I said, so this could be done in a single day or 2 days, not an issue. So let's put Small math here. 226 by 42, roughly it says 5 trading sessions. In case if it has back to back, the 42 points is pushing up. I could see only green candles. If there is any red candle, again there is a correction and then covering up that, that won't be a possible there as well. So again 226, let's do with 89. 2.5 trading sessions again I said. This is again where if it is a back to back consecutive green candles formation should be there. Will that be a form? No. Again, this is a daily data points, but our analysis is based on 4 hour time frame. Okay, 4 hour time frames. Now, the 4 hour time frame, but trend reversal I've seen whether the trend is been started to bull is in 30 minutes. That is the reason I'm showing it in 30 minutes. Okay, the analysis I've done it in 4 hour. The blue swings here, right? That one. Where was I? Okay, I was on Thursday. Sorry, November 22nd. Sorry, Tuesday. Fine. So next two Thursdays there will be volatile. So again, as I said, there will be an correction and then the market could move. So I can't expect in next 2 days the 226 points can move. So I have pushed my target to November 1. So what I do is I buy options of call options on November 1, Thursday's expiry. Fine. Then what happens? This target is reached here. This here. This target has reached here on November 24th Thursday. So which is um, November 24th. So we had an entry on November 22 here, and this target was reached in November 24th. So though we had the market could go on a correction, and what if that doesn't not happen, and if we had taken the expiry here, there will have a decent volatile and then we would have, but our target has reached in the current expiry itself. And if you had bought at the money or one or two strike price out of the money, you would have made a decent there will be a decent volatile in the market, and that could be a decent profit as well, and then you could have closed your profits in this one at this area itself, not an issue. If you had taken this one, the volatile here will be more after this expiry here. The next trading session like Friday it will start, then you can expect a volatile of this expiry premiums. Either you can hold it or you can close your position right here and then you can go further ahead. As I said, there is a 4 hour support here. Fine. The second target which I did from my Feb analysis is here. Let me show how it has happened. This is here. Fine. So this is for 16 points, 63 bars, which has reached in 63 bars is 63 by zero point 0.5 hours, which took 126 hours, where I divide by 6.5, it took 19 trading sessions. Listen, so this took the 19 trading sessions to reach this level. Fine. You sure 63 into zero point 0.5, 31, very good. Sorry, 63 into zero point 0.5 is 31 .5 hours divided by 6.5 hours is 4.8. I'm sorry, not 19. My wrong calculation. So it's give or take. It's a 5 trading sessions. I able to reach this for 16 points. As I said, now our entry would be in November 22nd, and if I have decided to take my trades on 1st of uh, November, that's Thursday's expiry, and our target was reached in 29th of November, which is here. You see here, just before the expiry. So, understanding your trend analysis and the number of points it moves in a daily, so that you don't do your analysis on daily, you do your analysis on 4 hour time frame, and then on the day in which you try to catch your impulse wave, and then you adjust your expiry, and through which you choose your strike price in the money, sorry, out of the money, how many strikes you move in, or at the money, and your day of expiry. So putting all together, you will understand uh, when to buy your options, and you can travel in that impulse, and then you can close your position. Once you're done, sorry, my bad. Once you are done with your trade, don't try to make another entry immediately. That's the next day, the next immediate day. Don't do that one. Actually, allow the market to cool down, allow the market to further do generate further structures, and then try to catch the next trend, rather than um, don't be in a hurry to catch every day trading. That don't do that one. Allow the market to cool down, to form another higher low from this was our target. Allow the market to stretch up a little bit, then again the market is cooled down a bit, then again look for the trend, then again try to trade in. That is how you have to allow the market to cool down, to form certain structures again. Else you will end up, um, what do we say, the immediately if the market turns, goes around the trend, and then again there is a change in the trend, we will be in a panic, as expiry is trying to reach out, and our premium will start hammering, and we will end up losing the capital as well. So patience is one of the key role in trading, especially in option trading. So let me show in 4 hour. As I showed, there is a swings here. See, higher lows, higher high, higher low, higher high, higher low, higher high, and now the market has broke here. If you would have further continued here, assuming the market will further go up, the trend has changed here. So you have to allow the market to breathe in for some time. The trend has changed. Now it's a lower low. Now allow to form lower high. Now here, if you had look for a trend reversal, so there is a double top here. If you look close here, this is a double top, and neckline has broke. So if we look for 30 minutes, again there will be a same. Let me show here. This is one drawback. I'll show why. Let me show in 30 minutes. Ta-da, ta-da. Yeah. So if you see, there is a double top and there is a neckline break and the market as well. So if we have, if we are in, what do we call, good enough that you wanted to catch this, the swing of this bear trend, and where you wanted to travel only till the, let me draw the zones as well for you. So this would be your support zone here for this swing. Fine. So this is lower low, then this is lower high, this is your zone. But whereas the target of this one here, let me draw the so this is my first target and this is my second target. So which took big time to reach here, and then this is another time to reach here. So we don't go very deep to reach the target, because there is again the market has gone against our expectations. So there will be some kind of a, what do we call, correction, and then we can lose the premium as well. So we don't do that. So either you can decide your target till the support of this 4 hour swing, or you can have fib target as well here. So either way you can plan. Assuming if you had planned it till here or here, again let me draw this one. This is my first target here. Fine. So let's go to 30 minutes. Yeah. So now here, after the double top neckline break here, this would be our entry point. So this would be my target. So 211 points. It took 27 bars of 30 minutes. So 27 bars here is 27 into 0.5 hours, divide by 6.5 trading hours. It took 2 to 3 trading sessions, roughly. So what would be my entry day? It would be, entry day is on Jan 4. Sorry, my entry day would be on Jan 4th at 11:45, after the 11:45. Jan 4th. It's Wednesday. So let me close this. Jan 4th is Wednesday, so I can't expect the target to hit in the next day. So I'll be choosing my expiries on 12th expiry, and it has reached in two trading sessions. So the target has reached in 6th of Jan Friday. That is here. So it has reached in next two trading session. The volatile, if you see here, the after the breakout, the market has gone for a retest. Then again, the market has fell fully. Then again, there is a one more correction here. The market has went up. Then again, the market has fell. So that is the reason I said this data here 42. If I consume the five trading sessions, if it is a back to back, it is a green candle of 42 is blocking up again and again and again. Then you will be able to reach the target. If there is small correction and then the market is going up, then this won't be there. So this is to take it as an approximation for the daily understanding. Then you can go down to your one time frame. If you go down, that will be more efficient, because here there could be small corrections happening as well. And to adjust the daily corrections, um, uh, points, and if we won't be able to reach the target in the given time frame, that is the reason I'm shifting my analysis time frame instead of daily to push it to 4 hour, so that more or less I can try to reach my target in the given time frame or given expiry. So this is the 27 bars I said. So this took some two trading sessions. So maybe if I taken this expiry, sorry, Jan 4th expiry, and my target is reached in 6th expiry. The target is 6th expiry is considering my 4 hour support zone. But I have taken the put options, I have bought the put options on for 11th expiries as well. So this is a good trade. Now the first target for me to reach here was not, this is based on support. For my first target on Feb is this one. Okay, it has reached here. Check now. The market has moved again in a double top in 4 hours, more or less like a double top in the 4 hour against the trend. Then again, it has market has moved out. So that is the reason I said the market can take a detour, go back to its original stop, then again it can come back. If this happens, if you're considering the daily movement, average movement of a Nifty here, considering this, the candles will be in case if it is an impulse, and you can keep adding one block of the above, and you will be reaching the 200 points in next four trading sessions. That is not the ideal scenario. That is the reason I said always don't the number of points which we have pulled out is on a daily data. Since that scenario is not possible, we are pulling our analysis to one time frame lower, that is 4 hour, where we are giving an enough breathing space in case if the market goes against the trend as well, in worst case scenario. So that is the reason we are shifting the analysis not in daily, we are shifting it to 4 hours. Let's see how long it took to reach this target. Okay, it took support here at 4 hours. Support as there's a speed breaker, there is a slowdown. It took against the trend, then again it came back. Again it took support, then again it went back. Okay, and how long it took after this? From here, it took, yeah, that is 474 points. It took 208 bars of 30 minutes, which is 208 into point 5, 104 hours. If I consider 6.5 trading sessions, it has taken 16 trading sessions to reach here, which is roughly 2 weeks. The target here it has reached 27th of Jan. Our entry was on 4th of Jan. This target was reached in 27th of Jan. Let's see, 4 Jan. Yeah. The 4th of Jan is here, and then this is 27th of Jan. So 27th is it? Yeah. So 27th of Jan. So let's consider, yeah, 27th of Jan. So I said I would have taken in 12th of Jan. So our expiry was 12th, 29th, and 26th. And I think in India there was a holiday here. There was no expiry for 26th. It's a Republic Day. then I think it was should be here this expiry. So probably there would be lot of loss in the premium, because one, it took lot of time, there is a time decay. Along with that, the market has moved against our trend, and because of that the premium would have been hammered very heavily, and there would be a loss in the market as well. So that is the reason I say, once you do your swing technical analysis, you draw your chart patterns, etc., understand how far the market can stretch up uh, to give the volatile in which we wanted to absorb the maximum results of the volatile in the market. So draw the support resistance of the analysis time frame, where the analysis was on 4 hour. So this 4 hour I have drawn over here, and then the higher time frames like weekly. If we have see, there is a weekly, the market has fell. Let me delete this. I think this is too much. You can't see here. Let me zoom in. Yeah, you see, this was the one which we were looking for. Then we have sold here in the market. From here it took time and then broke down. If you see here, we were on the weekly support. The weekly support was too strong here. That is the reason it took time to break. Then it broke out. So always draw the analysis time frame in which, like 4 hour time frame, and then higher time frame support resistance, because the higher time frame support resistance, it's hard to break. There will be a slowdown, or the market either can break taking some time, or the market can bounce from that higher time frame support or resistance as well, where the target to reach will be very delayed, or the market can go against our trend, or the both can happen together, which is very bad for the option trading, as there won't be volatile, or if the volatile is there, it will be in opposite direction. And if there is no volatile over a period of time, because of time decay, we lose the premium and then we lose the trade. So understand. So put your swing trades, put your support, put your swing target, put your support and resistance of the 4 hour time frame and a weekly time frame, and see whether there is any place where there is a slowdown in the market, which will result in slowing your volatile of your market, and that will give an understanding on how far you could risk your volatile, and decide how far you can choose your expiry as well. Based on that, choose your expiry, choose your strike price, calls or put options, and then do trade. And always give market to breathe in enough space, so that it will form another new structures like bull trend or bear trend. Then you'll figure out whether do you have an impulse wave, catch that impulse and then make a trade. This will improve your the success rate of your trades, and reduce the risk of losing a trade more often. Understand? As I already said, in case if you have done your trade here, this was our target, and there will be some push here, then immediately it was like, okay, let me do some analysis and then again try. Then again there is a trend has been reversed here, the market has fallen here. Then your bull trend, the call options you have taken would have been again against your trend, again you will be losing your premium. So that is where the market comes in to breathe in enough space, it forms a bear trend completely. Then we have got enough breathing space here, and we got a structure here. We have made a bear trend. Then again there is a double bottom, then neckline break. Then again there is a full bear trend here. You see here again the market has formed a double bottom. Then there is a neckline break. Then market has spiked up again. So if here we had have made a sell, I would have made say target till here, because this is a weekly support. Then to form this structure, let me show you. Okay, done here. Yeah, fine. Let me show how far the target. I'm sorry. So this would be my target here. This is my way of keeping my targets for the swings actually. Okay. So assuming I have trend reversal here, it took time, assuming from here till here to reach. That is 9 4 hour time frames. So 9 4 hours is 9 into sorry, I didn't go to the trend reversal in 30 minutes. I'm just to show an approximation on how long you will have to wait to another trade to take in. Okay, so 36 and divided by 6.5 per day, that is 5.5 days it came down. Now see, after this week, this is my target. After the target hit, it took the double bottom to neckline to break. It took 19 bars. The 19 bars is 19 into 4 into, I'm sorry, divide by 19, okay, 6.5 hours, which took 11 to 12 trading sessions. Is inclusive of weekends. If you take, it is almost like 2 weeks you have to wait for the structure to form. Then you had a double bottom neckline break, and this, if you consider this as a target, this target was here, okay, which would be your, from here if you consider your 250 points, and those 250 points took how many days from here. The 250 took your 5 4-hour bars, which is 5 cross 4 is 20, divide by 6.5, that is 3 trading sessions. In 3 trading sessions you have captured the 250, and that was back to back green candles. So there will be high volatile. Actually here there's one red candle, then you would have got that one. So that is the reason always I say, always be in a trend, catch your impulse, and once your trade is done, don't be in a hurry to make another trade assuming that there is still an impulse is there. Don't do that. So wait for the market to breathe in, give enough time to make another structure. So to form this, it took some 12 trading sessions. Inclusive of weekends, it will be like 2 weeks. 2 weeks, you have to wait with patience. You see here, this is a double bottom and this is a neckline. Don't break properly here. There is a break, and again market came for a retest and then it rallied. So um, if you have taken hurriedly, there is okay, double bottom neckline has broken, I'll take a trade. The market came for a retest. It is against the trend, and there is a movement of the market to break. It took like again 9 bars, 9 cross 4, 36 divided by 6.5. Again 5 trading sessions to pull back. Again there will be a loss for you in this point as well. So that is the reason I say always, don't be in a hurry. Allow the market to breathe in to form enough structure to understand whether we are in a bull trend or we're in a bear trend, and catch impulse always. Don't catch the corrective wave. And putting all the points together, technical analysis and the basics of option. So don't have to be in too much of be a wizard in option. So market goes up, buy option call, pre option calls. If market goes down, buy option puts. Understand which strike to choose in, then understand which expiry tools based on other parameters like your technical analysis, how many points, support resistance, your target, how many points are there. And this is a daily approximation to give. So since we go on 4-hour time frame for the analysis, and there is a possibility that the market could generate this as well. So back to back, it doesn't give you green candles or red candles for you to form. So this will be the structure formations as well. So in daily, so that is where we can't expect in a single stretch 40 to 42 can happen in next 4 or 5 days. So it can reach like 200 points in single go. So there will be a correction, there will be again pull, there will be again push, then we again pull. So that is the reason we don't do in daily. So we shift it to our 4-hour time frame for the analysis point. Then on in which day we are trying to catch that impulse, and how far we far away from the expiry, then decide which expiry would be an more or less an optimal. So there is not a very thumb rule or a formula or a roadmap. So these are all approximation. Putting all these variables in together, we can understand how far the volatility I can expect in the market in the given time frame of the expiry. Then I can jump in where I can expect a decent volatile, where my premium can spike up, and that's good for my um, to have a green numbers in my account. So this is what I wanted to give an understanding on how the option would be for in a very basic level. In case if you have a very hands-on grip on these techniques, then you can add more and more option strategies like straddles, what do we call, condors, iron condors, butterflies. Then, in case if you have a bull trend, then you can buy future, and you can hedge with put options. And the reverse, you can do it like when the bear trend, you can sell your future and hedge against your uh, sorry, yeah, call option, so something like that. So you do this way, future and option together, you will have a margin benefits as well. You will get margin benefits as well. So there are multiple benefits. You can do that. So once you become more and more professional with this, add more strategies like as I said, the condos, butterflies, spreads, bull call spread, bear call spreads, and so on, combined with the futures and so on. You can do these as well. In addition to that, so when you do this strategy builds, there are many tools like one I've seen is Sensible, but it's paid one. It's even SIBUL, Sensible. Yeah, Sensible. This is one which I found very helpful. Um, but this is a paid version. I think I don't have the premium right now. Anyways, okay, you can build your strategy here. Where is it? Where is it? Where is it? Screen tries trades. Yeah, strategy builder, you can go here. You can put your like expiry, you can add here, like here you see here, you can add your so these are the brokers we can directly connect in, and just with one click button, your strategy you build here, this will execute a basket order in your brokers altogether. So you don't have to like worry about which whether to have to execute my future first or option first, or which option to execute first to get the option, sorry, margin benefits and so on. So that is one uh, best thing. You will execute a basket order directly into your broker actually. So you can just go here, add your futures, like whether we have to add Nifty or Bank Nifty, or even you can do your FNOs of all stock FNOs and index FNOs as well. Then decide the expiry, decide the calls or puts, the strike price. Sorry, this is buy or sell. This is your calls or puts, the strike price, the lot size, and this is your premium. When you adjust everything, you can see what with the maximum profits, the maximum loss you can execute, the break even after which you will experience the profit or loss, and the risk reward ratio, the probability of success of your trades to execute, and this is the margin benefits you will show here as well. So I don't know if I can make something here. Let me show here if I can add a future here. So this is an option, add. No, I need to log in with some uh, my accounts actually. Let me see here. Okay, bingo, that's possible. Yeah. So you can even test your strategy whether it works or not. So I'll add a future here. So let me do, assuming it's still the Nifty is in buy. Yeah, the Nifty is still in a buy trend. So let me add a future here. Where is it? My bad. 25th May expiry. Let me do a buy. This is my future. So I have to do a for hedging purpose. I have to do a sell. So what do I sell? In case if market goes down, my so I do a buy here. So I'll delete this. So I'll buy instead of call. Let me buy put. Yeah. Okay. So let me do this one. I think I can stress this. Okay, fine, good. So this is what it is. Here, if you see here, I have bought a 25th May expiry. So let me shift it to like 25th May expiry as well. And mm, let me go here. Let me see, 25th expiry. Do I have anything? Yeah. So at the money is 18,000. So I have bought PE, that is 17 1735.3. Okay, this is one. So let me put here. I think that is there. Yeah. Now here, if you see, the maximum loss I can incur is 12,488. Fine. But the margin which will be adding up is 42,000. Number of NIC guidelines, this actual numbers required may be depending on broker. Yeah, so this is based upon some brokers. It can go up a little bit, but this is approximation again. So the only capital you need is 42,000, where you can buy one leg of your future and then the option, the same expiry. Okay, then with the break even of 18,250. Once if the Nifty crosses 18,250, then you will see your greens, your account start getting greens. By the time of expiry you can see maximum profit. This is unlimited, it's not doesn't mean that you can make it in crores and so on. At the time of expiry, if your uh, Nifty is above this break even, that is 18,250, by the time of March 25th, if the Nifty is above 20 like 250, then you could see some greens in your account. Again, before the expiry, as the market still pushes, you can see that some some small greens you can see here as well. See, on Tuesday 2nd May, you can see like 3,900 as profits, and as it go down you can see that it's crunching down. Okay, so as you keep pushing yourself up, see, by the time of expiry date, you say that I'm at the expiry date, if the market is at 18,250, your profit will be 13 rupees. If it is on tomorrow, that is Tuesday 2nd, then your profit would be expecting 5,747. As you go in, it says that at what price and what expiry and what date you can expect the target over there. You can see there. Okay, so there are again, you can add, you can build your strategies here. um, now spreads here, butterflies here, ratio spreads and so on. You can do uh, based on some inbuilts has been given, and you can add your positions as well. You can do a virtual trades as well to understand what would be the risk you are taking and how much you can make money at the time of expiry and so on. You can, this is very intuitive, and this is very um, nice, and it's very easy to understand as well. Assume now I am killing this like option leg. See here, you need 1.7 lakhs, 1 lakh 7,000 capital for the margin, in case if you buy only future. If we add one leg of option, you just need just 42,000, where your maximum risk, the market, even though market goes beyond any level, say if 18,250, beyond 18,000, and if it goes market beyond 18,000 and it goes to any loss extent, the max loss you can incur is just 12,500 bucks. That's it. So this sensible is one tool. There are many tools as well, where you can build your strategies and understand your option strategies as well. Try them out as well. um, I think Opstra is one. I don't know. OPSTRA. Yeah, Opstra strategy. Yeah, after strategy builder, option strategy builder as well. This is again, it's similar to Sensible, but I don't know if they do have the logins with the broker account as well. The another advantage, as I said, you can just directly log into your brokers. There are only few selected brokers in this. Then execute your build your strategy here, understand your risk rewards, how much your margin is required and so on. Once if you are fine with all this, just with single one buy button, it will execute your basket order into your brokers. So don't have to worry about which has to be executed first and second and so on. So you can adjust your day of target in which you wanted to do it, and then what would be the change in the curve here. So that is also possible, and you can see some option geeks, and there are some other tabs in here which will give you the other datas as well. So you can just go through here. As I said, it is a volatile based market. You can see the IV charts as well. So how far the volatile has been pushed up. uh, this is for you. You can just do your homework here and fine. I hope this video was helpful, and let me know if I was wrong at some point or if I have missed out something, so on. So it will be learning for me as well. And please do support on my channel and the trading view as well. Please do drop your comments, and your feedbacks are valuable, and let me know if there is anything that I have to cover more, and let me come up with those topics as well in the future videos as well. So trade safe and happy trading. It's a happy Labor Day. See you again on another video. Thank you. Bye bye.